Hello and welcome to ET Now Startup Central, India's first and only daily show dedicated to startups, technology and entrepreneurship. I'm Chandra Shrikant coming to you from India's technology hub, Bengaluru. And yesterday we spent a significant amount of time telling you about the Flipkart-Walmart deal that's barely a week away in terms of the impact this is going to have on the industry, on Flipkart, on Walmart, what it means for the internet and startup ecosystem in India. But this evening, at least in the first segment of Startup Central, we will talk about the details of the deal itself. Because remember the way Flipkart is structured, and we're just going to pull up graphics for you to tell you about the convoluted way in which Flipkart as a company is structured. So there is a holding company structure as far as Flipkart is concerned, where there is a Flipkart Limited Singapore, which is the ultimate holding company. Below that, you have the Flipkart Marketplace Private Limited, and within the marketplace is where the marketplace business, the logistics business. So you have various subsidiaries such as DSYN Technologies, Flipkart Mintra, FX Mart, Instacart, Click to Shop, International Private Limited, all those subsidiaries rolling into the marketplace business. So that's one part of the Flipkart structure. Now, if I have to look at the other part, you have Flipkart India Private Limited, which is the retail trade services, and within this you have the Jeeves Consumer Services, Flipkart Logistics Services, and one part of this also has the Mintra Designs Private Limited, as well as Flipkart Payment Limited and Flipkart Logistic Limited. So, you know, the way it's been structured all these years, it's a convoluted list of subsidiaries. So where is the Walmart investment going to kick in? From what we understand, this is going to happen at the holding company level in Singapore, because remember, India's FDI rules do not permit FDI in multi-brand retail. So Walmart will come in at the holding company level, and a major portion of this is of course going to be secondary share purchase, because some of Flipkart's major investors such as SoftBank, such as Tiger, are expected to pair a big portion of their stakes. But for more to understand on how this is going to work out, what sort of tax implications is this going to have both for shareholders as well as the buyer, we have two special guests joining us right here on ET Now Startup Central. We have Rakesh Nangia joining us from Noida, as well as Vaibhav Parekh from Nishit Desai Associates joining us from Bengaluru. Thank you so much, both of you, for joining us on Startup Central. Vaibhav, I'm going to come to you first. You know, it's a very convoluted structure of subsidiaries that Flipkart has created over the years. Do you think the structure itself led to this delay in the deal? Because people we've been speaking to say that the regulatory challenges, the taxation impact for Amazon is perhaps why this was taking a long time. Can you give us some perspective? Is this going to happen, you know, at the Singapore company level when the investment finally happens?
Okay, so let me first start by saying that, look, I don't know whether structure is convoluted or not. I don't think simply having multiple subsidiaries makes it a convoluted structure, if at all they have this structure. But to answer your question, if the deal is happening, and again, I'm not aware whether the deal is happening, but since the way the media reports, going by the media reports, if deal is happening, they will come at Singapore level, as you mentioned. And if somebody is buying shares of a Singapore level at a Singapore company, generally this itself does not lead to delay in doing a transaction. Having said it, a deal of this size, if it ever happens, then obviously there are a lot of things which needs to be taken care of. And if there are a lot of things to be taken care of, there will be a lot of time which will be taken to get everybody on board to make sure that nothing has been missed out. So it is, if at all this deal is happening, then this is not something which is unusual, that there is a lot of time taken to do this deal.
Right. Not unusual on the time taken. Rakesh, weigh in on that. It's not a straightforward structure, it's structured in various ways to accommodate a marketplace, to accommodate its retail businesses. And within that, you have the logistics business, you have one Myntra, you have one payment, and then you have the Instacart business. So it's a web of subsidiaries. Is this the normal course, the way internet companies are structured? Because traditionally, a lot of them prefer to be domiciled abroad, not in India, maybe to avail the benefits there. But what do you make of this?
See, if you see generally a company of this size, you generally find them, they will have a web of structures, and these could be horizontally, that could be vertically, and they could have the holding company maybe anywhere in the world. So I'm not saying limited to the Flipkart, but generally I'm saying it. So there's a very normal thing you find such businesses having such type of structures are concerned. And yes, you are true. Basically, at times you create the structures overseas to get a more tax efficiency, tax mitigation, and this remains a very prime purpose when you structure these things. Now, but there's a major change from last year. From 17-18, when you have a GAR, General Anti-Avoidance Rules in India, will this structure survive? Will this structure or the authorities is going to pierce through these structures? Or they are going to say that these structures are going to be only the tax mitigation, or one of the main objective was to gain the tax on it. The moment the revenue is able to prove that the objective was only or main objective was to have a tax benefit, so they can pierce through the structures, they can dismantle the structures, and they can deny you the tax preferable treatment which you are likely to do it. So the whole globally, at least you can say, has been changing. India has massively moved to the GAR, basically effective from financial year 17-18. So this is the first year which has closed. We will know the fallback once when these comes an inquiry by the revenue authorities. But you'll see in the next year or two, all these structures, all these business organizations, all these tax efficient mitigation advices are going to be seriously under challenge, basically, because the GAR can open the doors, GAR can pierce the corporate veil basically out of it, and the law is on the side now, basically. And the government of India generally follow a OECD model, and OECD model clearly says we'll deny you the treaty exemption also. So the company will have to prove the objective of this structure was to have only the business efficiency, business rationale, commercial expediency, and not the taxes of the structure.
Right.
But we do find such structures, but they will have a challenge to look forward.
Right.
They may have to relook into that.
Right. Right. Weber, would you agree, Rakesh, basically saying that, so far this has served them well, but going forward as India changes its litigation to suit international standards, the tax band might just use this as an opportunity to go after Flipkart. And we have already seen multiple instances where, the IT department already finds issues with the way internet companies are structured. Today, for example, just this afternoon, the ITAT disposed a revenue department charge against Flipkart where they wanted them to classify discounts as capital expenditure. But luckily for Flipkart, they do not have to shell out that 110 crore sum now. So is it only going to be a question of, time catching up with Flipkart, and will we see some sort of a consolidation happening in the way this deal is eventually structured? Of course, I know that it's not formal, it's not official yet, but will that be one of Walmart's key focus areas as they really consolidate the Flipkart operations?
So, a company of size of Flipkart, right? Any company where there are complicated structures or there are multiple subsidiaries, these structures keep on evolving as time goes by, keeping in mind the objective of the company, the size of the company, the laws prevailing at that point in time. So all this while, you will see in any company, the structures will keep on evolving. At some point of time, it will become, complex enough, and then again, there may be a consolidation. So let me put it this way, right? I do not know whether the objective of the structure which Flipkart has was of tax, but to the extent the laws have changed and things have happened, any new, let's say, shareholder or strategic investor which comes in Flipkart can decide and may decide to change it right? Based on what their objective is and based on what law prevails at that point in time. So the answer is, will you see change in structure? You could, possibly it may happen, even in this case, but generally it happens in most of the cases. Can it be simplified? Again, depend on the objective. As I said, I don't think what currently Flipkart has, just having multiple subsidiaries, is a convoluted structure. So it's very common for people to have multiple subsidiaries for various reasons. They are separate businesses, then you will need a separate subsidiary. But for example, if the objective of, let's say, assuming for a moment that Walmart deal actually happens, and if their objective is to simplify the structure, they may as well as do it.
Right. Coming to another important point, Rakesh, I want to understand what sort of tax implication this will have for the various shareholders of Flipkart. I mean, what kind of gain can India's income tax department possibly expect when this deal is finally done? Because Flipkart has many, many, many investors. A few are perhaps residents of India, but a lot of VC firms are not headquartered here. They are domiciled overseas. They have a whole bunch of foreign investors. So in terms of the capital gains implications, what do you see on that front?
See, as I said it, basically when Flipkart is there in India from last decade plus 10, 15 years, so when you had all these business reorganization structures growing globally, you were always setting up these structures as the most tax efficient jurisdiction globally. And one of the objective, obviously, clearly, or the main dominant objective was to have a tax mitigation or lower tax liability from capital gain was concerned when you divest your equity. Now what happens is when the GAR has come, very interesting, you see the GAR has made one thing very clear. Any arrangement which has been done before 1/4/2017 can still be dismantled in spite of the fact you were there for 5, 7, 10 years. The period will not matter anymore. So all the arrangement, even entered prior to that, will be subject to, can be relooked, or can be the corporate, the revenue authorities can break these structures basically. So I foresee not limited to what we are talking about Flipkart is concerned, but I'm generally talking about as a law in the country is concerned. All such structures who were there and who did not really move changing it prior to 1/4/2017, all will go through a serious, minute lens of the revenue authorities are concerned. And as I said it, the onus is on the SSE, onus is on the company, onus on the shareholders to prove that the dominant objective was other than the tax benefit. Second, what you'll find that every such business, such structures, is not limited, I said, to one company, will definitely come under the sharp lenses of the revenue authorities is concerned. So you'll find a serious challenge if you had your domicile in a jurisdiction like Mauritius, Singapore, Netherlands, where you had a low capital gain or nil capital gain was concerned, and you'll find those, you will have a challenge to prove to the revenue authorities, because revenue will not look at the structure, now revenue will look through the structure. Till a couple of years back, we followed a static approach. What was there? Court was following a static approach. But in few cases, we have an ambulatory approach. You move to a more, what you call a vibrant or aggressive approach, basically. So here the revenue is going to move to that, from this side is concerned. And as so here you're fully exposed. I'm not saying generally you're exposed till you do not prove your commercial expediency or rational to have your domicile in one country.
Right, right. Last question to you then, Vaibhav. In terms of the regulatory approvals required, from what we understand from our sources, the deal next week will be subject to approval by CCI, because, that might take another 45 days. But is that the only approval required at this point? Do the normal FDI rules even appeal in this transaction? Do they even figure in this transaction? Because while FDI is prohibited in multi-brand retail, Walmart will be coming in at the holding company level. It's a marketplace investment. So will the CCI approval be the only one that's required as far as from a government point of view, from a regulator point of view is concerned?
Yeah, so normally whenever somebody acquires a company which is situated outside India, which has subsidiaries and a business in India, then really speaking, the key portion which you look into is whether you require a CCI approval. If you are meeting the thresholds, then you may require a CCI approval. In this case, considering that Flipkart is a mature company, it is more likely than not that they may require. I don't know the number, so I cannot tell you that whether they will really require or not. But other than CCI approval, generally no approval is required in a case, especially in this sector, where someone is buying shares of a company which is not located in India. Now, having said it, even if they were buying shares in India, from FDI perspective, they would not have required approval because this is a marketplace and it is not a multi-brand retail company. So, from FDI perspective, it honestly would not have made a difference.
Right. On that note, Rakesh Nangya and Vaibhav Parikh, thank you so much for talking to ET Now, decoding the structure of this mega deal. Remember, it is going to be the biggest deal in Indian e-commerce that will close just in a few days from now. But on that note, time to take a break and come back because we have another very important story lined up. The government is sending a second notice to Facebook and Cambridge Analytica on the whole data leak scandal. What will the government's response be? Can they really expect a stronger response this time around? Come back for Startup Central after the break. Welcome back to Startup Central and on to an important story on the Facebook Cambridge Analytica episode. It seems the government is unhappy with the first response that they got and they now want a second one from the social networking giant. My colleague Tushar Chakrabarti joins in for more details. Tushar, what does the government want from Facebook and Cambridge Analytica this time around?
The government has sought more information on the data of Indians which have been collected by firms Facebook and Cambridge Analytica, and it has today issued a second set of notices seeking more details regarding the same. As far as Cambridge Analytica is concerned, sources tell ET Now that the government is not satisfied with the earlier response that the firm had given to the government on alleged misuse of data of Indian nationals, and therefore the government has sort of again issued a notice seeking what kind of data it has collected from Indians and whether or not there was any involvement of informed consent when such data was being harvested by Cambridge Analytica. As far as Facebook is concerned, the government has asked Facebook in this fresh notice that what additional steps it will be taking to ensure that its data is in no way used to influence the elections in the country, and has also sought a detailed response on Facebook's entire privacy policy. So the government today has sent a very exhaustive list of questions as far as the data privacy and data security of Indian nationals is concerned, and both these companies have until May 10th to submit their respective responses back to the government.
Let's get in an expert take on this. Saket Modi joins us on the phone line. Saket, what do you make of this? Is Facebook and Cambridge Analytica going to respond seriously to the government's notice, summons the second time around? What kind of response do you really expect from these two companies?
So, Chandra, I personally believe that this is an uncharted territory both for the social media company and the government itself, because the funny thing is that Facebook is not an Indian company, nor is Cambridge Analytica, but on the other side, Facebook's largest user base is sitting in India, and at the same time, Cambridge Analytica, I mean, now at least it definitely doesn't look like that it has any customers in India. So here's the point. From a compliance perspective, somebody like Cambridge Analytica does not necessarily need to go ahead and reveal anything or tell the government anything, because they by no means fall in the jurisdiction of India, or they are not answerable to the Indian government. But considering the stakes of Facebook in India, including with WhatsApp, because WhatsApp's largest user base is also in India, so I think, of course, Facebook would come out with a pretty detailed reply. From a reply from a Cambridge Analytica case perspective, it would, I think, have a standard reply. We've all seen the testimony of Mark Zuckerberg, and I think it would say the same thing, that there were issues from Facebook's side and they would apologize for that. Yeah.
Right. Saket, would it be fair to presume that unless we have a rigid data protection law in place, sending these summons, sending these notices is really going to be futile?
So I would not call it futile because, this at least is a sign that other social media companies or any company which is handling the data of consumers, whether they are paying for it or not, this is an alarm for them that they better be responsible with that data. But on the other side, I totally agree with the point that it's high time we need a proper data privacy policy. Europe has come out with a very strong one by the name of GDPR, General Data Protection Regulations. In fact, we are almost in the cusp of the entire Europe embracing it, because the date is 28th May 2018, by when every single company operating in Europe has to comply to GDPR, failing which they will be penalized in the tune of 2 to 4% of the global turnover. So it's that serious of a regulation that Europe has come out with. India definitely needs one. So we hope to get that very, very soon, because the Supreme Court is, of course, looking into it.
Right. On that note, Saket, thank you so much. In fact, the draft data protection law is expected in a month's time. And as you said, the GDPR kicks in next month, which is why Facebook has moved all its users outside North America and Europe back to the US from Ireland. That includes users from India. So lots at stake here. Perhaps the data protection law will protect us in future. But on that note, thank you so much for joining us on this edition of ET Now Startup Central. Stay tuned to ET Now for news and updates.